Welcome back to Bros on Finance. Today, we are taking a deep dive into Tesla's second quarter 2026 earnings report. If you look at the top line numbers, the headline story appears to be one of strong recovery. Deliveries bounced back sharply and revenues surged. But as always in corporate finance, the real narrative lies beneath the surface. The central question facing Tesla right now is no longer just how many vehicles it can move off the lot, but how much value Wall Street should assign to car manufacturing relative to software and AI infrastructure. Let us start with the headline operational figures. In the second quarter of 2026, Tesla delivered 480,100 vehicles globally, representing a 34% quarter-over-quarter rebound. Total revenue came in at $28.24 billion, up 26% year-over-year. Taken in isolation, these figures would suggest a powerful growth trajectory. However, the profitability metrics tell a drastically different story. Tesla reported a GAAP operating margin of just 1.4% for the quarter. Operating profit collapsed by 57% year-over-year, down to $398 million. The fundamental takeaway is clear. While sales volume and top-line revenues returned, operating profits failed to follow. Looking closer at the core automotive segment, the quarter-over-quarter volume recovery undeniably helped relieve inventory pressure built up earlier in the year. However, a rebound in delivery volume does not equal a restoration of pricing power. Across key global markets, Tesla relied heavily on financial subsidies, zero-interest loan promotions, and direct price incentives to move metal. In China, sales momentum was sustained primarily through aggressive financing subsidies. In Europe, regulatory movement around full self-driving testing improved the long-term narrative, yet underlying EV competition and price compression remained intense. Put simply, Tesla succeeded in moving units again, but profit quality per unit continues to be squeezed by competitive reality. This pricing pressure shows up clearly in automotive gross margins. Excluding regulatory credits, automotive gross margin declined from 19.2% in the first quarter down to 16.3% in the second quarter. It is worth noting a technical dynamic here. The first quarter benefited from one-off tailwinds, including warranty reserve adjustments and temporary tariff relief. As those one-time factors subsided in the second quarter, reported margins naturally stepped down. Even after accounting for these accounting adjustments, the broader economic signal remains undeniable. Tesla is actively sacrificing automotive margin to protect global delivery scale. Because automotive margins are under pressure, the market's focus has shifted to whether Tesla can re-rate its valuation from an automaker to an AI and software company. That brings us to full self-driving, or FSD. As of July 2026, active global FSD subscriptions reached 1.48 million, representing a 56% year-over-year increase. In North America, the take rate for FSD on new vehicle deliveries reached approximately 55%, following the strategic pivot toward monthly subscription models. This shift from upfront hardware sales to recurring software revenue is central to the bull thesis. Hardware sales generate a one-off transaction, whereas recurring subscriptions transform every vehicle sold into a long-term monetization node within a broader autonomous network. We see a similar strategic logic with the Cybercab initiative. Pilot production of the Cybercab has officially commenced at Gigafactory, Texas, with a targeted annual production capacity exceeding 125,000 units. Concurrently, public testing and pilot operations have expanded across 7 major cities in the United States. If these pilot programs successfully transition into fully uncrewed commercial operations, Tesla's valuation framework could shift from unit-level automotive margins towards service revenue per mile and fleet deployment scale. However, investors must recognize that the market is currently pricing future optionality rather than realized earnings. FSD subscriptions are growing and Cybercab pilot runs are underway, but whether these software streams can fully offset traditional auto margin compression remains an open question. The structural transition introduces the heaviest financial burden in the entire report, the massive capital expenditures required for AI infrastructure. During the second quarter, Tesla generated $4.7 billion in operating cash flow, which is a solid operational result. However, capital expenditures spiked to $5.79 billion over the same period. As a result, free cash flow plunged into negative territory at minus $1.09 billion. Management reaffirmed its full-year 2026 CapEx guidance at over $25 billion. This cash drain is not caused by operational failure, but rather by massive upfront capital commitments. Tesla is aggressively building out its Cortex 1 and Cortex 2 compute clusters, alongside its Terafab and Austin semiconductor facilities, to support training and inference for FSD, Robotaxi, and Optimus. Tesla is effectively transitioning from a high-margin manufacturer into a capital-intensive AI infrastructure provider. Meanwhile, Tesla's energy storage segment continues to mature. Second quarter Megapack deployments rebounded to 13.5 gigawatt-hours, up 41% quarter-over-quarter. Energy segment revenue reached $3.14 billion, solidifying its place as a significant business unit rather than a peripheral side venture. Yet, much like the automotive business, energy storage faced margin volatility. Segment gross margin fell from 39.5% in the first quarter to 20.4% in the second quarter. While energy storage represents a viable second growth curve, its current margin profile cannot single-handedly offset the dual pressures of auto margin compression and accelerating a CapEx. When we synthesize these results, Tesla today presents three distinct financial identities. First, as a traditional EV manufacturer, deliveries are rebounding but gross margins are constrained. Second, as a software and autonomous driving platform, FSD subscriptions are accelerating and robotaxi production is advancing. Third, as an AI infrastructure enterprise, capital expenditure is surging and free cash flow is temporarily negative. Bulls argue that low operating margins are simply the price of admission for a generational pivot into autonomous platforms. Bears contend that auto profits are shrinking, CapEx is burning cash, and AI monetization remains largely unproven on the income statement. To evaluate Tesla over the next 6 to 12 months, investors should monitor 6 specific metrics. First, whether North American FSD attach rates hold above 50% while total active subscriptions expand. Second, whether auto gross margin excluding credits can hold a floor around 15%. Third, whether free cash flow can return to positive territory amid heavy CapEx. Fourth, whether Cybercab pilots yield verified driverless commercial data. Fifth, whether energy gross margins recover 30%. And sixth, whether European regulatory approvals for FSD materialize. These data points will determine whether Tesla is undergoing a temporary margin trough or entering a costlier capital-heavy validation cycle. Thank you for watching Bro Sun Finance. We present data without financial advice. Subscribe for ongoing institutional-grade analysis.